welcome. You're watching Money9 News and I'm Sakshi Batra. The Securities and Exchange Board of India, in a move that could step up investors' confidence, has now told the mutual fund industry that a fifth of the salary of the top executives is now to be paid in the form of mutual fund units of the schemes that they oversee. So what's the aim of doing this by SEBI, and what will be the implications and what is in it for you and me, the mutual fund investors? To understand all of this and to answer a whole lot of questions around this, I have with me a very special guest joining in. With me is Mr. Feroze, Azeez, Deputy CEO, Anand, Rathi Wealth Management. Welcome to the show, Mr. Azeez, and thank you very much for taking out time to speak about this very important issue.
Thank you, Sakshi.
It's a pleasure to have you with us. Let me take your first take on this whole new rule by SEBI. Is it a surprise move? Was it already something that the SEBI was considering? And how are you looking at it? What has really led SEBI to do this?
See, I think it's not a surprise move. The action might be a little surprising, but they were mulling over trying to increase the skin in the game and improve the confidence of investors, especially after one or two bad episodes. The Franklin Templeton episode has definitely catalyzed this process of the regulator thinking in this direction of increasing and improving investor sentiment towards the industry, and that having a long-term benefit. So I am very, very happy with this move. Of course, there are so many nitty-gritties which require more thinking, but at a concept level and the implementation is critical. But I am really excited because skin in the game brings in confidence, confidence brings in penetration, penetration brings in return for the investor, because from FDs, they move into a more tax efficient, more return efficient platform.
Absolutely. So do you think that from the investor's point of view, this will improve their conviction and they will continue to investing in mutual funds and perhaps with more conviction now?
Yes, Sakshi, I think investors derive a lot of comfort when their advisors or their fund managers do what's being said to them. Now, for example, I've met several investors over the last couple of decades. I've been in the industry. They definitely become very calm when they know what you invested in. When I share my portfolio with them, they feel very comforted, and that actually results in a call to action. Otherwise, then they're just in two minds. They're sitting on the fence. Once they see your balance sheet, your portfolio, your demat accounts, they get that comfort. So there is a need from the investor, and this definitely addresses the need to calm the anxiety which most investors have.
Absolutely. And do you also think, on the other hand, this will also make mutual fund managers, the top management, more accountable and have their skin, like you just said, sort of in the game, and this would lead to perhaps better selection of securities and also performance?
See, I think, Sakshi, most fund managers have a very large component of their compensation related to performance already. Most fund managers' bonuses are completely linked to how much extra return, or alpha as they call it, they make. What's the performance, what are the mistakes they do actually dents their bonuses. So large portion of their compensation, which is bonus and ESOPs, are linked to performance. So I don't see this as a very big incentive for change in performance, but definitely change in governance will be happening.
But do you also see that this could perhaps prevent incidences like the Franklin Templeton mutual fund kind of fiasco that we've seen, or any such kind of bad investments winding up of the schemes like that, which absolutely devastates the investors' confidence?
Yes, Sakshi. See, not one action changes an event, but a series of regulatory actions, this being one of them, I can confidently say, can avoid an episode or a speed breaker like the industry had last March or April 23rd. Yeah, so it's been a year. So point being made is this definitely will reduce the probability, but singly, no specific action of the regulator can single-handedly see through events being avoided, but this definitely will reduce the probability of an episode like the one which we had last year.
Right, but mutual fund managers see this as a very difficult step to, get implemented. Like you also said, that implementation would be perhaps critical, and we'll have to look at the nitty-gritties. So, because if some fund managers have too many schemes which they manage, does this pose, more risk for them and, a bigger concern for them?
Yes, Sakshi. I think, see, personal finance, as we call it, it has to be personal. A circular cannot white label everybody's personal finance into one straight jacket and assume that people with different age, different goals, different liabilities, different salary brackets, all of them will come under the same roof and invest as per the scheme they manage or as per the asset management company's assets in different schemes, which is impractical. But my hope and prayer always is the regulator is very receptive. Whenever regulator has brought in circulars and has definitely subsequently looked at points which don't make practical implementable steps and has changed it. So I'm very, very hopeful and very sure, looking at the past behavioral pattern of a regulator, that there will be amendments, but the spirit will be withheld.
So there is scope for negotiation with the regulator on this. I mean, like for now, we know that the circular says that this thing should come into effect by July. Between that period, there could be some negotiations with the AMCs, and they could perhaps find a middle path where it does not hurt them too much as well.
Yes, Sakshi, that's my belief. Of course, there's no certainty to that statement because time will tell. But you have to make your guesses out of your past experience of behavior of the regulator, who always takes any point which is sensible, interprets it, and then reacts. Not just it's not so fixated in its policies. So I'm sure something like any employee should not have 40 schemes. Will be something which SEBI will definitely consider to make it simple enough to implement and not go with what has been released just because it's been released.
Right. Now, there's one more concern that most of the fund managers have brought out, and they actually see that perhaps there could have been a better way of, improving the governance, if that is the intent, or to just, help the investors' confidence build up rather than just making this mandatory. But on the other hand, do you also see this as a fair, step by SEBI, a 20% mandate? Because most of the industries now have their salaries linked to bonus. So it is actually fair in that respect as well.
Yes, it's very fair, Sakshi. I don't think it's a big deal if you do the math. For example, let's break this down into two different kinds of employees. The CIOs, the CEOs, the fund managers who earn in the range of 2 to 6 crores or even more, right? There, let's assume a person has a 1 crore rupee salary after tax, the senior guys I'm speaking of, after tax if they have a crore, and they will also have 10 crores of investments, if not more. Over the years, they would have at least collected 10 crores of investments if their 1 crore is their CTC post-tax. So what is the regulator saying? Invest 20 lakh rupees a year, which is nothing but 2% of the total 10 crores which they actually have. I'm very sure with my friends in the industry, whom I would have had a conversation for long periods of time, most of them would have invested 3-4 crores out of the 10 crores total net worth in their own schemes. So 2%, not a big amount. So for large employees, it's not a big amount. And for the smaller ones, the lock-in is just 3 years. So the younger employees can recycle the same money year on year. So because if there is a 30 lakh rupee salary, 20 lakhs post-tax, the regulator is saying in the next 3 years, in your schemes, please invest 12 lakh rupees, which I'm sure is not a very uphill task, as long as regulator is ready to listen to the valid points. And I think if you have skin in the game, put it on paper. That will have a huge benefit to the industry, which is what the regulator is doing.
Do you think this will also change the investors' behavioral pattern, looking at the fact that the fund managers, the key employees of your AMC are invested, have their 20% of their salaries invested in the funds and the schemes that you are in, and that will be also locked in for a period of 3 years? Will this also change the investors' behavior for a positive fact that they will also perhaps want to invest much more, till 20%, say if they were doing just about 3, 4, 5% of their salaries, and they can increase to that? And the lock-in period also, they would keep that in mind too.
Yes, definitely. There is a rub-off effect in client behavior or investor behavior that you've seen over the last 7-8 years. It has really progressed because of regulatory moves. So I personally believe that now there's a benchmark. If an advisor and investor is having a conversation, he at least says the benchmark of minimum systematic investment plan should be 20% of your salary, if not more. So it creates a benchmark. It also creates a thought process on the time frame of a mutual fund investment, which is 3 years. So I can't agree with you more, Sakshi, and both these points are very valid and have a large influence over a period on retail investor behavior.
Also help us understand what is the practice in developed markets on this aspect. We have already seen that, just like how you pointed out, that most of the managers voluntarily have their investments in their own schemes. Is it also a regulation that is there outside for us to compare this kind of a regulation from SEBI?
Sakshi, we have looked up several countries, and there's no precedence to this kind of a mandatory, non-voluntary contribution in terms of scheme units as your compensation. There are quite a few large asset management companies, be it Fidelity or First Pacific, all these, or Vanguard, have a certain degree of voluntary guidelines for their employees in terms of contributions from their salaries. But there's no precedence in terms of a mandated regulator diktat kind of circular we found globally.
Right. Now we have seen that the capital markets regulator time and again comes out with these steps so that investors' confidence can be increased with respect to investments in equities, in mutual funds as well. And this is one step towards it, like you also said. But if I to ask you, looking at your experience that you have in the industry and such changes, how have they changed the perception of the people who are investing? I mean, if I were to ask you to quantify for me, say, for example, how many investors do we have in India who are invested in mutual funds, and with this kind of step, how much more increase do you expect?
See, firstly, I think there's a lot which has changed, especially from 2013, when SEBI made a mandate to spend a reasonable amount of money on investor education. From the existing AUM, 0.02% was being spent year on year, which runs into thousands of crores now, more than 1,000 for sure, in investor education. Now that strategic steps taken has definitely helped us. In illustration, if you take the last year's pandemic, you didn't see carnage, you didn't see retail investors shying away from continuing their SIPs. So we're back into the peak levels of SIPs. This has not happened overnight. This has happened because of the regulators' strategic thinking. So I really think it's very good. Coming back to your pointed question, Sakshi, what kind of investor base today do we have? Of course, counting unique investors is a tough task across AMCs. There are estimates of about 2.5 crores unique investors, unique PAN numbers who invest in the mutual fund industry. But that is a very small penetration. Globally, that penetration could be 50-fold, for example, in the US, where mutual funds are mandatory in retirement savings, 401k they call it. So India, there is no mandate of using mutual funds for retirement corpuses so far. So I think the penetration is low. I would say that in the next 4, 5, 6 years, if the steps like these are taken in chronological order of importance, I think penetrating at least 3-fold more from here as unique investors should be very easily possible in the next 6, 7 years.
Okay, then thank you very much, Mr. Azeez, for speaking to us on this very, very critical issue, helping us understand, and all the viewers of Money9, as to how this step by SEBI will help them and also all the investors of mutual funds to build up their confidence, spend more wisely in the mutual funds, and invest in these critical schemes that can help them build a wealth-generating portfolio for the long term as well. Thank you very much. It's been a pleasure speaking to you. Thank you. And with that, it's a wrap on this edition of Money9 News. We'll keep bringing you all the news that impacts your wallet. So stay tuned and logged on to money9.com.